Hello, it's January 4th, and we are in the middle of a pretty good meltdown right now, pretty good sell-off. Now, just for context, up here is the S&P, and we're actually only a little bit off the all-time highs. In fact, we were at all-time highs earlier today. So really, it's not like we're truly crashing yet, but it is a pretty sharp and sudden reversal, especially in the Nasdaq, as we can see here. So this is actually a fine time to put on a trade. Right now at 11 a.m., we're going to put on one of our most core positions. It's the futures options strangle. That sounds all fancy, but it's actually pretty simple. We're actually just going to do what we call a normal kind of 25 delta next month, not front month, next month, strangle on the Nasdaq. We're going to try 15,300 on the downside. So we're hoping it doesn't fall below that by February 18th. On the high side, we'll also do a 25 delta here. So let's call it 16.9. All right. Markets are a little bit wide when things are a little bit crazy right now. So we're actually going to cheat this a little bit closer to the ask side of the strangle, and then we'll go ahead and adjust that downwards. So what are we doing? We're actually going to get 7,400 in credit if this works out well. And it reduces our buying power by 27,000. That's actually a great capital efficiency ratio. We'll talk about more of that a lot later. And this is even in a retirement account. So futures options are definitely the way to go. If you're collecting premium in any sort of Roth IRA or IRA account. Just a quick follow-up, yesterday's Tesla trade has gone very well. Remember, we put it on at, right around 1,200 for Tesla on the 1x2. It's coming very, very nicely. I can bring that up on the options trader right here. If you look right now, the exact trade we put on for 21 yesterday, we can actually do it for significantly less. I mean, actually, this is attractive enough. I would consider throwing out an ask right around 1,100 or maybe 1,000. So if we can basically make 50% of the premium back in one day, if we can make 50% of the premium back in one day, I'll take it. So I'll let that sit there, see if it fills, but we're still working on this important strangle. Looks like they're going to make us pay up for it. It's all right. It's okay. This better fill. Nope. Well, catching a little bit of a bounce back. That's one of the reasons. We'll talk more about delta theta ratios later, but it's might actually be a good idea for me to follow this up with some short delta later on, just to protect things against a total crash. Nope, not happening. Well, maybe it's not meant to be. Maybe we don't force it just yet. Oh, there it is. Ding, ding. And that's a wrap for today. We put on a Nasdaq 25 delta strangle to take advantage of what might just be a one-day kind of move to the downside. We've seen a whole lot of people buy on the dip in recent months. Basically, this entire COVID episode, buy the dip, has worked. Now, I'm not saying we're joining them necessarily, but if we sell vol on a day with a big downtick like this, either we make it back in a day just like Tesla and close the position and we're happy, or if we see a continued prolonged slide, yes, we will have to manage the position a little bit, but hopefully within 3 or 4 weeks or at expiry, it still won't be a problem and will be profitable. So the benefit of doing this strategy is we do have multiple ways to win. Talk more about that later on future days, but thank you very much today. All right, the trade today was to sell a put at 15,300 strike and then a call at 16,900 strike. Both of them are not quite one standard deviation away, both expiring in 45 days. The idea is as long as the Nasdaq stays between these two numbers, 15,300, 16,900, everything is okay. And at expiry, we would make the entire premium sold, a little bit more than $6,000 or $7,000. However, the risks are when you run beyond the strike prices at either end. So you're hoping for stability. If you cross through 15,300 on the downside, we still have a region where we're profitable because the premium we collect still covers the losses from the put. However, once we blow this up a little bit, I'll do it on here. We can actually see when the movements become a little bit more violent, such as a 30% move in either direction. That initial $7,000 or so you pocket from selling the premium actually can turn into a very large loss. By the time you get to 14,500, we've already lost $8,000. If it crashes all the way down to 13,000, which is quite possible if we have a big 20% downturn, we're actually losing on this trade $38,000. Pretty bad compared to the $7,000 we're getting up front. However, these are all tail risks that we're hoping either won't happen, or even if they do happen, they happen in a way that we can manage that risk or hedge that risk as it comes. But no mistake about it, these are risky trades.